When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shea, and I'm just here to ask the questions, but of course, the words of wisdom is solid advice. They come from the other Jeff in this radio program. That would be Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how's it going for you this weekend?
It's going great. Always good to be with you. Always good to kind of wind up a week with a nice radio show, just venting and getting stuff off my chest.
That's right.
That's what I usually do nowadays.
Yeah, there's no lack of opinion on this show. But I think that's what I like about the show, and a lot of people like too, is that you really don't hold back. And, I'll ask you a question at the beginning of the show, and 10 minutes later, you're answering the question still. But, there's a lot of ground to cover here. There's a lot of stuff to talk about. And I think it's really important for people to get a sense of who you are and what your values and opinions are when they come in to sit down with you to get a financial plan, because they want people that think just like them. So with that in mind, Jeff, I'm going to throw a couple of things out here. Most recently was the fact that Jerome Powell, I think he was on 60 Minutes yet again, and he says that the United States is on an unsustainable fiscal path, that the national debt is growing faster than the economy. I mean, that's no big secret that we've got a big national debt, but, that's the thing is, what are we going to do about this, or what can be done? And I think that there's some disagreement in Congress and in Washington about how to cure this problem.
Well, the problem is everybody wants to be reelected, and they always just look forward to the next election and try to make everything as rosy as they can, but they keep digging a hole financially, and it's like there's a credit card with unlimited debt, but pretty soon the bank's going to say, sorry, no more money, you can't borrow anymore. Like, what do you mean? What do you mean we can't borrow? We just print money, right? Can't you just print money for us? And eventually it's going to say, no, there's going to be a reset. I don't know how long. Yeah, I think Powell's right. It's unsustainable, especially when the GDP growth is 60% or better coming from government spending, which is really just taxpayers. It's just churning taxpayer dollars. Churning and burning the taxpayer dollar through fake, hiring a bunch of government employees, which is, a big part of the supposed job creation. We have tons of jobs being lost. We can talk about that a little bit more later. I think, second worst in a decade or so. I don't remember what the article said. Bottom line is, they're still laying off people, but the government keeps saying they're creating jobs because they're spending money. So a lot of this GDP growth is just fake government spending, which is digging the hole deeper. And it's just like a smoke and mirror game, which, can't be sustained. I don't understand how, when GDP is, barely growing at 2%, but most of that is government spending. That's not a healthy demand. Shoot, population growth just by, not just population growth, but immigration and everything else. The country's growing at much faster than that. So on a per capita or percentage basis, or when you look at what the average consumer is benefiting by GDP growth, not much. Yet we're not benefiting by this big hole we're digging in debt, just because we decided, in the Obama years that we could just start printing money. Before that, there was, I believe it was less than $8 trillion. I think it was $4 trillion. Then Bush had a few extra trillion. Then Obama from 8 to 32 since then. Now, yeah, some of it happened during Trump's reign too, because the Fed just realized that printing money is a good thing for everybody, right? Well, it really isn't. It just seemed good at the time. Now, COVID kind of exacerbated the problem where there needed to be some bailouts. You got to keep the plane from crashing, technically. I get that. But when there's places to land and you could have a soft landing, but you just insist on keep on flying in the plane, eventually we're going to crash into a mountain. I think that's kind of a good analogy of the situation we're on. We're just flying along, and it's unsustainable. We can't just keep on manufacturing fuel for our plane out of thin air. Pretty soon it's we got to do something about it. So Powell's shouting the warning cry, but Congress and any elected official doesn't seem to want to hear about it. Some of them, again, it's not really you can't even pick sides on this one. It seems like everybody, the swamp is a swamp. It doesn't matter what party they're in. They're all just kind of either giving it lip service or saying we got to do what we got to do because, socialism means we have to pay for everybody's everything and we have to print money to do it. And then we complain about inflation and shrinkonomics, and Bidenomics is working. Look at all the jobs we created, but it isn't working. Look at all the jobs we're losing. We're creating minimum wage jobs in the government sector, and we're losing jobs in the high tech, AI sector, all this stuff that's supposed supposed to be the next generation of economic growth, is companies are having to lay off people because they're not growing. So Powell should be shouting from the rooftops, but he doesn't really get heard much because there's an election coming up. So what are they going to do? They're going to continue to print money. Last week I talked about how the bank term funding program was ending March 11th, and supposedly the bank's supposed to start buying all the crappy defaulting notes and loans that the bank basically collateralized in order to give the banks money to survive last year, instead of go out of business like Silicon Valley Bank and a few others. Actually, a lot of others have gone out of business. We don't really hear it much on the news other than the couple of big ones that kind of caused the initial panic. Well, then the banks have been propped up for the whole year with fake money. They were supposed to start paying that money back, and they haven't been. I think it's interesting how the financial sector, from the standpoint of stocks, is one of the strongest sectors out there. If you look at like ETFs that have financials in it, the large financials, the big cap financials like the JP Morgans and the Bank Americas and so forth, that index is doing great. Well, how is it doing great when defaults are at an all-time high on credit cards and commercial loans and just about everything out there? They've got interest rates at 7 or 8%, which they can barely make any loans. Nobody wants to borrow at that rate. And they've got to pay consumers 5% or better on a CD just to get them to leave their deposits in the bank so that they can function. Where are they making their money? Well, they're not. They're getting bailed out, and the money's just all coming from the taxpayer, from the Fed, handing it to them to make it look like the economy's all hunky-dory fine and painting this rosy picture. But it is unsustainable. I mean, pretty soon the Fed can't keep giving banks money because the balance sheet of all the collateralized loans, basically when they put money into the economy, called QE, quantitative easing, what they do is they basically buy bonds. They basically give money. They inject money in the system by buying debt from banks, consumers, or institutions. Now they're trying to take that back by selling the bonds. And in order to sell the bonds, because nobody really wants government bonds, they have to keep raising rates to get them to buy them. So they keep raising rates so that people want to buy a bond at 3, 4, 5% or better, even higher for junk bonds. I mean, they're even getting their fingers in not just the treasuries, but corporates and everything else. So the Fed's playing both sides of the fence here, trying to reduce money out of the economy to curb inflation. At the same time, they're propping up the banks. And the banks are doing what? They're not loaning the money out. They're not doing what they're supposed to do. The banks are kind of in this limbo phase, yet their stocks continue to rise. How is that? Well, the only thing I can see is all the trading that they're doing. They're in control. Bank of America is Merrill Lynch. Morgan Stanley is JP Morgan. You've got all these big institutions are one and the same as a bank, although they're supposed to operate differently. They don't. Their hands are tied together. They're joined together at the hip like Siamese twins. They, feed each other. So as long as, Wall Street doesn't fail or the banks don't fail, Wall Street can continue to play its games and manipulate the market and use all this Fed money to continue to buy stocks up to outrageous prices to make it look like the world is in great shape and we're not going to have a recession and all the things that they're saying now. Powell says they're going to lower interest rates. Oh, that's going to make the market strong. Well, they're not really going to lower interest rates, are they? The big lie was it was just a big hoax back in the fall when they said, oh, we're going to stop raising interest rates. We'll probably never have more rate hikes because inflation's going to just somehow get down to 2% without us continuing to intervene. All the while we're giving banks money to trade and to pump into the economy and to really do QE in the back door while they're doing QT, quantitative tightening, in the front door. And most people aren't seeing it and going like, well, gee, inflation must be getting in check because interest rates are over 5%. Surely they don't have to raise them higher than that. And then they say, oh, we're not going to raise them. In fact, we're going to lower them maybe 3 times. Well, how many times have they lowered them? It's March already, and everybody was saying it would start by March. Well, it didn't happen, did it? So, when are we going to have these rate decreases? Well, now they're saying, well, we'll probably still have 3. It'll be probably June, September, and December. Well, who says? I mean, Powell already BS'd us because he probably got pressured by Wall Street or by banks or somebody that wanted big bonuses by the end of the year because they wanted to bid the market up with this, backdoor QE programs that they're doing. And when those didn't work, they said, oh, well, just tell the people a bunch of BS to make them think that if we lower interest rates, the market's going to be so good next year, they'll want to buy it in advance, which they did and continued to do so even through the beginning couple months of this year. So there's a lot of manipulation going. I'm glad to hear, Powell throwing a few truths out there instead of just, perpetuating this BS about lowering interest rates so he can prop up the market and make whoever's in the White House happy because, he works for them, essentially. So, supposedly not, but, whoever's in the White House has a great influence. And, Wall Street has great influence on both parties, the White House and the Fed at the same time. And I understand they do have to work together, but, some of this manipulation and just the things that we're seeing in the market, Powell says he's going to lower interest rates 3 times, and right out the door, banks say, oh, no, we think it's going to be 7. Well, who said 7? Powell didn't even say 3, really. He said up to 3. And everybody else in the Fed says, no way. We haven't even talked about that in our Federal Open Market Committee meetings. So how is it we're going to lower interest rates? Well, we're not seeing it yet. And honestly, I think there's a big camp out there, and I'm leaning that way. I've got a foot in it that says they're not going to lower them this year. They'll probably end up having to raise them a little bit. And, unless more companies start laying off people and we start showing signs of a true recession, which honestly, historically, we should. We've got the yield curve inverted. We've got all those stats I keep talking about every week that, really haven't missed historically, that have always ended up in recession, yet somehow now we don't have any, we're not going to go through a recession. Everything's going to be hunky-dory fine. Well, that's usually the loudest cry right before the biggest crashes. So, let's just see what happens. I'm not a doom and gloomer. But I do believe in market cycles. The market cycles continue to repeat. They always have. They always will. And we're just going to have to take it like a man, dust ourselves off when it's over, and regroup and do it again. America's a great place as long as we still have, capitalism and freedom, at least to a certain degree, to do business and to, right the ship on our own financially, then good for us. But it also speaks to how silly it would be to have all your investments riding on something that you can't control and something that's based on a lot of things that even Jerome Powell says are unsustainable. And that is this economic print money and keep digging our debt hole bigger and bigger and bigger. It's unsustainable. It's already got past unsustainable. They already, blew past rational levels of quantitative easing through some bad times. And there's still money out there. Shoot, a lot of that, infrastructure money is still getting spent. The money that went to the individuals, not so much. So, the money out there is drying up. It is getting harder and harder for anybody except the rich to keep getting richer. And the middle class are suffering because inflation is a real problem. Producer price index went up. All the things that have to happen because of the state we're in is hurting the consumer. It's hurting the middle class more than anybody. Rich people, they're going to afford it. They're going to handle it. And, honestly, most of them could, ride a market correction out and because they're not spending their stock market retirement assets for paychecks, right? But the people that aren't rich, that need a more predictable, income stream, ought not to be looking at investing in something that is so precariously perched, on this Fed system that is, as Powell said, unsustainable. The fact is a fact, and I'm glad he's saying it. I think he's, setting himself up to when he gets to say down the road in June and the rest of this year that we can't have rate decreases and we're going to probably have rate increases. That he's kind of setting the stage and helping people think a little bit more rationally. And I think that's why we're seeing a lot of the pullback and the softness in the market, even with the big companies, the Magnificent Seven. They're kind of slowing up a little bit. They're looking like they're going to turn over. They're a little choppy lately, and I think it might be either the market pausing or the market realizing that what Jerome Powell is saying is also true with the market. This is unsustainable. You just can't overpay for assets over and over again and increase their values and compounding those increases when there's actually decreases in earnings. Last year, I said in the last few programs, it looked like last year the earnings were up about 0.8%, but it turned out the fourth quarter of 2023 S&P earnings on an overall basis were actually down. So the year ended up with 0.4, I believe is the number. And that means we had actually decreasing earnings. So earnings went up less than 1%. The market went up 30-ish. And somehow there's a justification is, but that was because we were basing on future earnings. Well, the forward-looking earnings didn't happen. They got zero. They were expecting forward earnings of like 20% increases and, big rebounds from the market crash of 2022, and they didn't get it. So now what they're doing is saying, but we could still, we think the market's stable. We're not going to have a recession. And because of all the rate decreases that we have to have because Powell said so and all the banks think so. And because inflation, which is now going up at a bigger clip than it has in almost a year from a month-to-month basis, and 4 out of the last 5 months has gone up, not down. Somehow inflation is going to just return to that level when the trend is up. That doesn't make any sense. How can that happen? So inflation is not getting under control. The market is not going to get any relief. And I think we need to, sit back and take it with a dose of reality. I think the market needs to realize that, next year they've got baked in 25 or 30% growth rates on some of these companies when last year they had the same thing and it didn't happen. I think we can kind of bet on the same thing happening this year. Too much inflation, too much unknowns. Yeah, it's an election year. Yeah, the Fed's doing all they can, backdoor quantitative easing, printing money. They're still printing money. Jerome Powell says we can't do it. I think he's trying to get the voice of reason out there so that maybe more pressure is put on from the broader base of Congress and so forth, that maybe they'll put pressure on the White House to just kind of let market forces kind of come back into play a little bit here, where it's not a manipulated market, but one that is more market-based. And in that case, there's going to be a reset. So it's unlikely that big resets happen in an election year because usually they'll manipulate through it, but they've done so much manipulation prior to this. I don't know if there's that much left. I'd say, we need to go forward with a little bit of caution, even though typically this time of year is a good market time, but also we've got all these bubbles ready to pop too. So it's probably as most concerning and probably as confusing as any market that I've seen in 35 years of in this business. And when people that are much older than I am, like even Warren Buffett selling, I think he's still got about 160 billion in cash. I think he was up to 200 billion at one time, selling stocks, not buying stocks, except I guess one Occidental, probably a good buy there. If he's buying it, maybe he knows something. But, smart people are scratching their head. People that have been in this business longer than I am saying, like, why would anybody be buying this market here? I'm not. And the smart people are saying, I've never been so confused. That makes me feel better because I don't think I've been this confused with so many different forces pushing the market up that should be pulling the market back, forces that say the economy is really in a stinky situation, layoffs happening, inflation going really more out of control than it's being given credit for, producer price index going up 0.6% in February, which is, if you look at that forward, if it went up 0.6% every month, that's 7.2% in a year. You compound that, we're up over 8. That's 8% inflation again from the producer price standpoint. You don't think that's going to pass on to the consumer? Of course it is. Either pass on to the consumer by putting 8%, less chips in the bag, potato chips, or less ice cream in the tub, or whatever. The shrinkonomics is real because that really means inflation is real. It's kind of funny. Bidenomics is fixing the world, but blaming the producers for cutting the amount of goods and services you get for the same price to accommodate the inflation. Hello, there's no connection between or in his mind about the cause and effect of the crappy policies that are in play right now. And man, I can't imagine what 4 more years of Bidenomics would do to the country. I think, like in the words of Trump, it'd be a bloodbath, not an insurrection, bloodbath. Gee whiz, let's go crazy with the news here. A bloodbath, meaning it's people are it's like blood in the streets. Wall Street's probably going to crash. People are not going to be able to afford stuff. It's going to be more and more unemployment. And it's going to just be one more step to the government controlling everybody and being in charge, because talk about socialism. The only way to save everybody when they're forced to be poor is to give more handouts and, create this huge government-run society of elitists that take care of the serfs and peasants that are out in the streets trying to work for a living and make the best they can. So it seems like that's the agenda of the other part of the party in power. I hope it's not. I got a little political. Yeah, okay. Most people listening to this radio show are okay with a little bit of politics, but that's not my point. My point is, politics do affect your money, and we have to be aware of what's going on in politics. And thankfully, Jerome Powell's, shouting a warning cry. I think it's a little too late. I think he started raising interest rates too late. The Fed's always too late at things, and then they got to go fix it and pick up the pieces later. So we'll see how it falls. The nice part is you can make financial plans that really don't matter politically, or it doesn't matter if the market crashes. We can still protect ourselves. We can still do things. I'm not being doom and gloom saying, oh my gosh, we're all going to suffer. I think by and large, the average Joe in public that doesn't know anything but what Wall Street tells them or what the news tells them is going to get in trouble, because a lot of it's BS. And so I think you just need to be more aware of the bigger picture and make sure that you understand all the tools and things that you can do to protect yourself from whatever this agenda is that's trying to make financial situations harder for everybody instead of easier.
Our show is called Premier Retirement. We're talking with Jeff Ogan, founder and president of Premier Retirement Planning and Wealth Management in Tucson and Mesa. We're talking about what's going on in the economy and in the world today and in the markets. In the meantime, if you're listening to the program, you like what Jeff has been talking about, his views resonate with you, you want to get in and sit down and talk with Jeff about your individual situation, see how the market and the economy affects you and your journey towards a confident retirement, we are offering a no-cost, no-obligation opportunity to sit down with Jeff. We call it our Premier Retirement Roadmap. To get yours, no cost, no obligation, 520-780-9059. You can make that call this weekend if you want while you're thinking about it. Why not sit down, have an opportunity to speak with Jeff on a one-on-one basis, and not just get general advice, but really get advice based on your individual situation. As I said, it's not going to cost you a dime. Why wouldn't you make that call this weekend? 520-780-9059. Leave your name, your telephone number. Shelley will give you a call back on Monday and set you up with an appointment with Jeff. Once again, one call could make all the difference. 520-780-9059. You can also request your plan online at premret.com. That's PREMRET.com. Jeff, I've been reading recently that there have been more layoffs in the tech sector since the beginning of 24 this year, 2.5 months. 50,000 employees have been laid off from more than 200 tech companies. What do you make of this? Is this just, again, thinning of the herd when we got fat during the COVID era?
Yeah. Tech really did take a boom. I mean, people were working out of their houses. They're hiring all kinds of people to do a lot of stuff, in the tech sector. But I think with this AI focus, the AI craze, so to speak, a lot of companies are kind of dropping what they were doing, maybe, or refocusing onto the AI situation. But there's two thoughts that I have with this, the laying off. First of all, when you lay off employees, it's kind of a direct shot right to the bottom line because payroll costs go down immediately. So you might see actually earnings increase, and it might be kind of a false positive, so to speak, that makes it sound like, oh, these companies are doing great. Well, if you lay off 10% or 20% of your workforce, you also have 10 or 20% less productivity from the standpoint of anything implementing new programs, research and development for, what's going to sustain that company 2-3 years down the road. And while it might make the stocks pop, or it might make the stocks or the company look in a perceived way maybe a little bit more profitable, their price earnings ratio might look a little bit better. I know that's really what happened to Meta, in my opinion, last year is, the metaverse, as they stopped doing their Meta thing and started just talking about, more advertising and more of their Facebook core business, and let a whole bunch of people go that were developing the metaverse and some of this stuff that's supposed to be kind of that future of AI for Meta or for Facebook. So, without that, what are they going to do to make up the difference in the future? And, let's look at what's happening in the market right now. The stock gets higher earnings, gaps up 20% in a day a couple months ago when they announced earnings, which they did a couple months ago, maybe 6 weeks, whatever. And then you've got Mark Zuckerberg, the president of Meta. You've got all this earnings growth, and they're all excited about how awesome everything's going with AI and all the future and blah, 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 blah. The stock goes up. Then why does Zuckerberg, sell $500 million of stock 2 or 3 times? I think he's done it maybe 3 or 4. Why is it when Amazon's getting into the AI business with chips and, this big cloud and internet stuff that they're supporting the worldwide AI growth infrastructure and being a big player in that business and supposedly, getting a lot of traction stock price wise, good earnings, kind of a surprise on the upside earnings. And Jeff Bezos, instead of saying, yeah, look at how good our company's doing, I'm going to buy more of my stock or I'm going to keep my stock, he sells $8 billion worth of stock. And also they were laying off tens of thousands of people not too many months ago either. So you got Meta laying off people, all of a sudden their earnings go up, stock goes crazy, and the owner sells out. Amazon, same thing. You've got Google, they kind of came into some soft earnings. I don't think they laid off quite as many people, but they also had layoffs. Their earnings still came in a little bit under expectations, and their stock's been rolling over not too well lately. You've got Apple. Apple is getting some of their iPhones banned in China, and some of their sourcing has been difficult. And I apparently, we all of a sudden we've seen their stock dip and get a little choppy, and they're not receiving the growth that they were supposedly going to do. And they stopped building the electric car because they can't see them competing with China and Tesla and anybody else that's already in the business. So that space has kind of been a lost cause for them. So, they're dialing back. There's a lot of companies in the tech industry that, have been hyped for getting into so many different businesses that are not coming to fruition. So, what does that mean? Well, it's not adding to GDP. The future is a little bit sketchy if they're not, keeping those really good employees. I mean, these companies we're talking about hire the best of the best when it comes to just technical ability to do the job. They're not hiring their minimum wage workers only and keeping their best. They're keeping some of their best, but a lot of these people are really high paid, very highly qualified individuals that no longer have a job because the company can't afford them. Because honestly, a lot of tech for the average consumer is discretionary expense. It's not a mandatory expense like maybe trying to keep up with the Joneses in the corporate world is, where you have to upgrade your computers and your internet and everything else and your cybersecurity because you've got to stay in business. Those are somewhat required. So that end of the business might not be suffering. But when it comes to inflation hitting the middle class, and iPhones are something the middle class uses, Google and small businesses use the advertising, the AdWords, and all the type of things that Google makes money on, website development and so forth. They've got Meta, again, another big advertiser. Are they going to be an AI company? Are they going to be an advertising company where, all they do is, pitch products and, hook you on Instagram Reels and, take over TikTok eventually? And is that really something that everybody can continue to spend money on? Maybe, maybe not. Inflation is hurting the consumer's expenses in the tech world. And I believe that it's going to filter up and hurt the tech companies' profit lines, which might finally trickle into the fact that when they've reduced employment to about the skinniest that they can get, then, we really have no choice but to see maybe some more stock sell-offs or some stock buybacks like we've been having, but more stock sell-offs to keep the companies, solvent and going. And I think that's when we see this recession that they say isn't going to happen. I think it'll end up happening. I don't know when, but I think we're kicking the can down the road pretty far, and I don't know how much longer it can be kicked down.
Jeff, I hate to interrupt you, but we're up against a break here. We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management in Tucson and Mesa. If you want to sit down with Jeff, once again, have that conversation about your retirement journey, offering a no-cost, no-obligation Premier Retirement Review. You can get yours by calling 520-780-9059, 520-780-9059. Jeff, time for a break. When we come back, we've got listener questions and more when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making us a part of your weekend. You're listening to Premier Retirement with Jeff Hogan. We've had a very robust conversation in the first part of our program today about current events, what's going on in the markets and the economy. If you have missed that or any part of our radio program, we're also a podcast. Simply go to wherever you get your podcasts, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so that you can stay on top of your journey towards a confident retirement. Okay, Jeff, in this section, we have listener questions this week. We'll start with Janice, who's listening to us in Tucson. And Janice writes, my question concerns my 19-year-old daughter. In 2023, she earned less than $13,500 in income, so didn't file a tax return on her behalf. Can I still open a Roth account in her name if she did not file income taxes in 2023? Was it a good decision to hold off on her filing, or is that something that you would recommend regardless of her income?
Well, here's the deal. If you want to do a Roth, you can't put money in there for her. Technically, she has to do it in her own name. I mean, whether she spent her $13,500 already, you want to give her some money, I guess that's up to you. But you can't open a Roth for a kid. Your kid has to open it themselves, and they have to have earned income to fund it. So if you want to open the Roth, she could just open it. She's 19 years old. She can open an account at Fidelity or someplace. If she wants to, just go online and find a place and open it. Even your bank probably has a Roth account you can open. Now, in order to qualify to fund a Roth, you have to have earned income. If you don't file taxes, it might be kind of weird to try to have to prove that you had income even though you never filed taxes. So either a W-2 would suffice, I think, that would, prove earnings, or, if it was like under the table income, tip income, or just, landscape in the neighbor's house or something like that. That's what I used to do to make my $13,000 a summer back in the day. And I never had any receipts, but I did, when I think the limit was like $4,000, I had to file taxes on it. But, at that point, you've got a record. So if you don't have any type of a W-2 or some record that you've made money in order to prove to the IRS that was a legitimate contribution to a Roth IRA, it probably wouldn't be a bad idea to file. You can do a really simple filing and say, this is what I made and this is what I contributed to my Roth. Now, keep in mind, the Roth is on after-tax assets. There would be no taxes owed. But depending on the income and also depending on whether or not there was a W-2 with Social Security withheld and so forth, you might want to file a tax just to get the Social Security income credit. Now, if it was under the table type income or stuff you did in cash, or like contract work, 1099 stuff, and you file a tax return, they're going to want to hit you up for a little bit of Social Security contribution. So your Roth is going to end up costing you a little bit more than it's worth. And I'm not saying to be a tax evader by any means. I just think, understand the rules and play along. But it's good that you're getting involved in your daughter's situation and financial situation. I think it's great that you're encouraging her to start a Roth, especially a Roth, because it's after-tax income. She has no taxes. She does not need a tax write-off. It blows my mind how many people, including parents, just say, start an IRA, Well, guess what? That's tax deferred, and later you're going to have to pay tax on all that growth when you pull the money out. So yeah, do the Roths when you're young. Do them when you don't have a tax problem. Do them when you don't need a tax deduction. In fact, do Roths as much as you can throughout your working life, if you can, because chances are you can afford the taxes while you're working, especially in the early years when you don't have a high income or when you're writing off child tax credits and tuitions in school and different things like that. Gives you a chance to invest in Roth. So that would be my long answer to short question, as usual. Good luck with that, but keep going Roth with her.
And Janice, we do applaud your intentional parenting there, and thanks for listening to us. We will send you out Jeff's book, Retirement the Road Ahead. You can pass it on to your 19-year-old daughter, but at 19 years old, I don't know if she's really thinking about retirement just yet. Next question, Jeff, is Spencer listening to us in Casa Grande, and he says, I'm 62 and I'm thinking about strategy for retirement. I'm planning to work until I'm age 70. Now, my wife and I, who is the same age, will both be taking Social Security, which will amount to about $5,000 a month. We've got about $1.7 million in stocks and bonds. How would you go about deciding how to more safely invest our assets, and how much should we count on at the beginning of retirement and the stages that come later? So $5,000 a month, $1.7 million in assets, going to work for another 8 years.
Well, I assume that while you're working, you're going to be putting a little bit of that money away as well for the next 8 years. So $1.7 million in stocks and bonds. I don't know how much of that is in IRA 401k money. If it all is, then I would encourage you to take a good look at your future tax problems, because you've already got one. I mean, if the $1.7 million is tax deferred and it doubles, which should be easy in the next 8 years. I shouldn't say easy. If it's all in stocks and bonds and the bonds go down and the stocks get crashed and you've got it all at risk, you may not have the 1.7. But as far as restructuring in a way that we do here at Premier and building a roadmap where that 1.7 could be kind of a guarantee of $150,000 or so a year guaranteed lifetime income, plus maybe another couple $1 million in assets that you can draw on, whenever you need it. Or if you have some of that money that's not in IRAs, or if you're in a low tax bracket, you've been a good saver, but maybe you don't make $300,000 a year, maybe you make $100,000 or less. And I'm guessing with $5,000 a month in Social Security, if that's between you, I'm guessing that you haven't always been at a super high income. You've just been a super high saver. Now, if that $5,000 a month is each at age 70, that means you're maxing out your Social Security. You're probably making a ton of money. I mean, I don't say a ton, but maybe $250,000 between you or more, maybe $300,000 or more to them. So maybe that's your lifestyle. You've got the $5,000 a month, that's $60,000 in Social Security. I'm going to just assume that that's a gross number, and you need another $150,000 on top of that to live on. Now, do you want that money to come out and be taxed every year, so you're paying taxes at $200,000 a year for the rest of your retirement life? And, also pay double for your Medicare premiums through IRMA, the income respected Medicare premiums. Basically, your Medicare Part B goes up. The more money you make, the more money you show on your tax returns. So my suggestion would be, instead of continuing to contribute to your 401k, let that 1.7 million, if that is a total problem, or maybe you've got $1 million in 401ks and you can turn that into taxable income of maybe 100,000 or so, 5 or 10 years from now when you decide to retire. And the other money you could actually convert and roll into a LIRP, a life insurance type version of an indexed annuity, where the market makes the value go up. But if the market doesn't do well, you don't lose money, but you do it in a tax-free or tax-advantaged environment. You also never actually withdraw money from that account. It's like your tax-free bank. You actually borrow from yourself at a rate most often lower, or at worst case, the same as what you make on that account. So if you end up rolling a bunch of money into a tax-free account, you can pull money out in any given year, or you could use extra money in any given year, either for trips, to help your kids, to buy a new car, to just add on to your house, buy a new house, send somebody to college. Whatever the case is, you can use that tax advantaged account, and any money that you use for income from that account does not show up on a tax return, does not force your taxable income up. So I've got clients that, have kind of this same range of assets that are getting ready to retire, and some of them have maybe twice that assets that are, closer to retirement, like you will be. And, instead of living on $250,000 or $300,000 a year in potential retirement income and having to pay tax on nearly all of it, we can structure something over the next 5 or 6 years, or in your case, almost, you got 8 years left, to restructure your assets in a place where you might be able to live on $250,000 a year and only pay tax on $100,000 a year of income. I mean, wouldn't that be nice to kind of look poor but live rich? That's what we do when we add tax planning into an income plan. We use different sources for retirement planning. We don't take all your money and stick it in risk, which, 1.7 could easily be worth $900,000 in a year if we have a big sell-off, and it could take another till you're 70 years old before the market gets back to the 1.7 million. Why not take some of that 1.7? You've worked hard for it off the table, lock it into a future income stream that generates more than enough cash that you need to live on to pay your bills and have some fun, and then just maybe risk what's left, or just risk the new money that you put into the 401k from here till you retire at age 70, and just kind of dollar cost average into the market. So fluctuations in the market and the ups and downs of the market won't bother you if you're not risking 1.7 million, if you're only risking your new deposits to that account plus the company match that you might be getting from the 401k, assuming you are getting a 401k. If all this has been done outside of 401ks and IRAs on your own, well, bless your hearts for living on less than you make and living a responsible lifestyle and be able to save that much money for your retirement. So it's a good example of somebody that's lived responsibly. You're still in your 60s. You probably have enough to retire right now, I would imagine, on a pretty meaningful basis. but going to age 70, taking higher Social Security and, possibly doubling what you have to work with in 7 or 8 years or somewhere close to that. Potentially, I should say the word potentially, because nothing's guaranteed if it's in stocks and bonds. But if you do move it to places that are guaranteed, you could see those numbers in a much more predictable, guaranteed fashion that'll give you a little bit more peace of mind as far as where those paychecks are coming from. As far as how much you should count on in the beginning of retirement and stages that come later, I don't have very many people come in, but I actually had a person come in just this week that said, this is what I have. I know I have plenty to live on, but I want to live on double what my budget is for the next 10 years, at least double. And then we can go back down to more sane, income. It was like, over 300,000 because he just wanted to travel and do everything he could during the go-go years and spend more up front. And he had the ability to do that. In the meantime, we set aside enough so that in 10 years, he'd be guaranteed when he did finally settle down and not need to do anything, he'd still have his 150 or so to live on. So again, I think you're thinking the right thing. I'm going to go and kind of answer that question again to kind of, maybe dog a little bit on the industry. And I think it's crazy that people that want to do retirement planning want to keep you in the stock and bond market forever and spend as little of your money as you possibly can. Oh, because of inflation, you're going to need your $1.7 million is going to have to be worth $5 million when you're 90 because of inflation. Don't spend any money. Spend less than 4%. The rule is 4%. Spend less than that. All that is just a song and dance to get you to leave your money in there and keep paying them fees and commissions over and over again on the same money. My opinion is it's your money. Keep it that way. That's what our slogan is of our company. It's because it's your money. You should be able to spend it. Use it. Make it fun. Make your ideal retirement and spend it when you can spend it and enjoy it. So having more of a flatline income plan is, I think, in my opinion, wiser than spending a little bit now just so you can save and spend 2 or 3 times in your 90s what you could spend now. I'd flip that, or at least keep your income somewhat levelized. And that's the kind of plans that we do. And after 30 plus years of doing this for people, I see that is a better deal. You get to enjoy life more on your terms. I have not met the person that spends more when they're 90 than they spent in their 60s. I have not met that person. And that is even including the factor of inflation compounding over the last 20 or 30 years.
Spencer, thanks for listening to us in Casa Grande. We appreciate that question. And of course, we'll be sending you out Jeff's book, Retirement, The Road Ahead. All right, Jeff, next question comes from Carl in Rita Ranch. Carl says, Jeff, how do bond funds work? I have money in a bond fund and would like to have a better understanding of it. I'm also not sure whether investing in individual bonds would be better than investing in a bond fund. What's your opinion?
Well, individual bonds are kind of a tricky thing. You have to pay a commission or a spread every time you buy one. So, honestly, I like bond ETFs that really just give us a good picture of the overall bond market. Exchange traded funds have very low fees. They basically buy the bonds at wholesale, almost no spreads, no commissions. So you do save a little bit of money using a bond manager or a fund. The other thing is they're a little bit more liquid. You don't have to worry about, one bond maybe getting into sort of financial trouble. Let's just say you bought a bond from XYZ company and, they just found out that they're getting sued for a bunch of money and, may not be able to pay the interest on that bond. Guess what? That bond is not worth $1,000 anymore. It's worth $500. I mean, it loses value. If you have a bond fund where, less than 0.2% of bonds ever go into default, you've got a piece of so many bonds that if there is ever a default question, it didn't turn out that you picked the wrong bond. Now, I'm talking about corporate bonds here. Now, if you're talking about government bonds, treasuries, treasuries are about the safest place you can park money, I think, on the planet. Some people say, oh, yeah, but the dollar isn't valuable. Yeah, if you live in America, the dollar is just as valuable as yesterday. It just maybe buys less because of inflation. It doesn't matter what foreign currencies are worth compared to ours or what interest rates are or inflation rates are in other countries compared to ours because we live here and we use dollars. But, if you're an international trader, that might come into play, but we're not. So as far as the bond market goes, if you're just looking at, treasuries, you can buy short-term treasuries, which is what we're buying right now. Not only do they pay more interest, they're also more liquid, and they come due like every day. There's something that comes due that contributes to keeping those funds liquid. So I would definitely prefer funds or ETFs over individual bonds. Individual bond, honestly, it's a painful process in my opinion. If you have a broker advisor that trades individual bonds, they're getting a cut of the spread. Especially if you're paying them a fee, I think that's kind of double dipping. So you probably shouldn't worry about that. The other thing that I want to talk about bonds and bond funds, keep in mind when interest rates go up, bonds go down in value because if interest rates go up, that means like right now, as I mentioned in the first segment, the Fed is selling us some bonds and they'll sell us a bond. And in other words, we give them $1,000 for a bond and they're going to pay us 5% for the next 3 months. And then it comes due and then we buy another bond and whatever. Or we can buy 10-year bonds and we're getting a little over 4% for those. Well, how come we're getting less? Well, because you're locked in for at least 10 years. That's good. But let's just say interest rates go up and Fed says, hey, you know what? We're going to start paying here. We'll sell you this bond and give us $1,000. We'll pay you 5% now for a new bond, a new 10-year bond. And you go like, well, shoot, that's better than 4. I want to sell my 4% bonds and buy the 5s. Well, what can you sell the 4% bonds for today? Well, the interest rate's higher on the new bond, so you're going to lose money. You're going to lose the difference of about 10%. The present value of about 10%, which is probably about 5 or 6% is what you'd drop in bond value just by that 1% rate hike. You'd lose 5% in bond value that day. So the only way to not lose that is to hold to maturity and make your 4%, and you miss out on the 5. So bonds do correct. They do go down in value in an interest rate rising environment. And that's why we saw bonds. There's bond portfolios, long-term bond portfolios are down 15 to 20% still because of the rate increases that they've had over the last couple of years, just because you can buy new bonds at a much higher rate than the ones you bought 2-3 years ago at near zero. So again, be careful about bonds. Bonds can be risky if you think interest rates are going up, and I think they might not go up too much more, but every little fluctuation up or down seems to move longer term bond portfolios. So if you want a nice smooth ride, I'd say, go short term for a while, use an ETF or a fund. I would use an ETF, exchange traded fund. There's plenty. You can just type it into or Google it, exchange traded funds, which I buy. You can even, like if you have a Vanguard or a Fidelity account or something, you can just go on and just look at the tickers for short-term bonds or even long-term bonds. But remember, long-term bonds are going to fluctuate in value. If you think interest rates are going to go down, and I do think they will over the next couple of years, it might not be a bad idea to buy a bunch of 3 and 4% bond portfolios, because you might make 8 or 10 or 12 or 15% on those if interest rates go back down to 2 or 3% like they were before the interest rates were, hiked by the Fed. So again, that's kind of how bonds work. Bonds are kind of like a teeter-totter. If interest rates go up, the bonds go down. If interest rates go down, the bonds go up in value. But again, if you just buy one, hold it to maturity, you get the interest rate that they promised, and you get your money back plus interest. So that's how they work. Hope that answers your question.
Carl, thank you so much for that question and for listening to us in Rita Ranch. Of course, we'll send you out Jeff's book, Retirement: The Road Ahead. If you have a question you would like us to answer on the air, it's quite simple to get it to us. All you've got to do is go to our website, premred.com, premret.com. Go ahead and put your question in there. If we answer it on the air, we will send you out Jeff's book, Retirement: The Road Ahead. Once again, you can go to premret.com, premret.com, and submit your questions. And also, if you would like to sit down with Jeff and talk to him personally and ask your individual questions to get your individual answers, we're offering a no-cost, no-obligation Premier Retirement Roadmap. In order to get yours, call 520-780-9059. It's 520-780-9059. Just a very confidential conversation between you and Jeff to get your questions answered so that you can get the information that you need to create a path towards a confident retirement. Again, it's not going to cost you a dime, but it could make all the difference, this call, that is. 520-780-9059. Go ahead, give it a call this weekend. Leave your name, your telephone number. Shelley will give you a call back during the coming week, and she'll set you up for an appointment with Jeff at your convenience. Once again, 520-780-9059, or you can request your appointment online at premret.com, premret.com. Jeff, one of the questions that we have gotten this past week, we didn't have time for it last week, but it was from a fellow named Bill who asked questions about laddering, and he's talking about laddering bonds or laddering CDs. So he wants to know what laddering is and when it's best used.
Well, I think laddering is an interesting concept. It's mostly used when you ladder bonds or you ladder CDs or something where you always have some liquidity coming due soon in your account. For example, a laddered bond account might say that you buy a bond in March, June, September, and December, and every quarter you have a bond that comes maybe due. Maybe you buy 1-year bonds, maybe you buy 2-year, maybe you buy 3s, and you buy them continually. Some people do this like their whole life. They just kind of playing leapfrog. They just keep buying the next bond, and then every so often they have a bond that's due, and they get to go shop the rates and see if they want to reinvest in a bond or not. But you can also ladder bonds because of the fact that bonds do change value when interest rates go up and down. Some people like the predictable income that bonds would provide, or a CD would provide. Like you might ladder a CD. Right now, you might be able to get a 3-year CD for 3.5%, and you think, well, in 3 years, that sounds like a pretty good rate, but right now I want 5.5. So, maybe banks will give you 5.5 right now because they're trying to buy deposits so they can keep investing in NVIDIA stocks and crazy stuff. So, they'll give you more on your money. Well, buy that 5.6. Maybe every year you need money for Christmas time or whatever. So you buy, a $50,000 CD that's going to expire in December every year. So you buy one for next year, you buy one for the year after, you buy one for the year after. You might get different rates, but at least you have that money that you know is going to come due at that particular time. Now, keep in mind, now, I particularly don't really like CDs. I don't even like bonds really for laddering because you have to pay interest whether you use the money or not. It may or may not be efficient, at least when you're talking about big dollars. I like laddering when it comes to, you can even ladder annuities. There's annuities that give you a guaranteed growth rate if you promise to, use it for income down the road. For example, you can use an annuity where you buy an annuity and it gives you back principal plus interest for the next 5 years. And then in 5 years, you put another chunk, in an annuity that matures in 5 years to give you a 5 or a 10-year payout of principal plus interest. The cool thing about that is the annuities, while they're waiting to mature, are totally tax deferred, and you only pay taxes on the percentage of interest that you get from those payments. You don't have to pay tax on just one big fat paycheck of interest, every year, whether you use it or not. So it's a little more tax efficient that way. I also believe you can ladder not just bonds or CDs or annuities. You can ladder different asset classes. For example, some people call it like the bucket of money theory, where you have different buckets of money, your short-term money. Maybe right now, you're really happy with 5% in cash and you've got some money liquid that you want to pay your bills on, but you could buy an index annuity with an income rider that, you could put $500,000 in and in 5 years be guaranteed that you're going to make, $60,000 a year in income for the rest of your life. But if you take the income right now, it's only going to be $35,000 in income for the rest of your life. Well, great. Let's ladder your assets so that you use your interest bearing cash liquid money for 5 or 10 years or however long it takes to get to that next income phase. And then you might say, well, I've got also this money that I really want to take some chances on and swing for the fences. I don't plan to use it for income. I can wait at least 10 years on it. Well, great. Let's buy some really good stocks or even buy the index and assume that over time the indexes will play out. Now, I don't think that every decade is going to be a good decade, and we learned that with 2000 to 2010. That was the lost decade. It turned out two big crashes, ate up the gains, and it took 10 years just to get back to even on the S&P, and then it took 14 or 15 years to get back to even on the NASDAQ. So, if it isn't truly long-term money, you shouldn't ladder it into a long-term type of an account, but you can ladder in a fashion with that as well. So it depends if you want to ladder assets so they come due like every day or every month or every week or every year, then you might want to use, some of those more liquid things like short-term bonds, maybe money market accounts, maybe short-term CDs and so forth. But if you want to build a retirement plan over a few decades, you should ladder the asset classes that you have as well. One other asset class I didn't mention, I like CDs for bank money. With the interest rates the way they are, that's awesome. We also have CDs on the brokerage side too. If they can compete, because I'm a fee based on the brokerage side, maybe it's not as efficient as just having some bank money in a CD at the bank. But we have CDs if you want to just do short-term CDs and let us ladder that for you. Or we use bonds that might pay a little bit higher interest or lock in a little bit higher interest rate. Honestly, insurance companies are doing a better job laddering annuities like that, short-term and mid-term and long-term annuities, where you can not just a predictable, but a guaranteed income stream. And we already know what the taxes are going to be on each of your paychecks. And we can already plan out your, next 30 years of tax returns if you do a tax efficient money plan, where you can't really do that with when you're laddering bonds and just taking whatever the next interest rate is. You kind of pay interest as you go, whether you use the money or not. Anyway, there's a few, I would say, limitations to the typical Wall Street or bank laddered bond or CD program. There's a lot better opportunities if you use some of the better paying longer term products that are more tax efficient. And one that I haven't mentioned yet is the LIRP, Life Insurance Retirement Plan. You can also set that up to where that could be additional income, even starting from the first few years. And as you ladder bonds or CDs and they come due, you can roll them into the LIRP, which is a life insurance. It's a tax-free bank account, basically. It's secured by a life insurance policy, which you don't have to pay very much for because you don't buy a ton of life insurance in these plans. You buy just enough to make it legal and qualify for the IRS, to fall into the IRS guidelines and rules for tax-free income. And at that point, you can keep sticking money that you've already paid taxes on in there, never pay tax again, have it grow at a reasonable rate based on indexes in the market, but also have principal protection so that it doesn't lose money when the markets crash. So it's got a good track record. It's got great potential. And anytime you want money, you can use it from that policy. You don't even take it out. You just borrow against it. And the money that you borrow and spend keeps growing at an equal or better rate than what you borrow. So I think that's a pretty strong asset that you ought to add to that ladder in order to generate some income. And you don't have to say, oh, this is going to be my 10-year laddered income. Unless you're in your 40s, maybe you want to wait till you're 50 or 60 before you start taking income from that type of a plan. But you can ladder or you can structure different investments so that they pay either a different amount or a different level of income over a different period of time. I think that's kind of a broader definition of laddering, but I think it would work for if you want to look at an entire retirement plan.
Once again, Jeff, we're a little short of time this week. Bill, thanks for that question about laddering. And once again, if you've got questions of Jeff, you'd like to have a private conversation with him to ask your questions, no cost, no obligation, and no judgment for this review. 520-780-9059 is the number to call. Go ahead and give it a call this weekend. 520-780-9059. You can also contact us online at primrat.com. Jeff, out of time for this week. I want to thank you for your time, but most of all, I want to thank our listeners for joining us. For Jeff Bogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.